How did political battles create the Federal Reserve? Imagine a time when the United States had no central bank, and the economy was like a roller coaster with frequent crashes. That was the reality before the Federal Reserve came into existence. The story begins in the early 1900s, a period full of financial chaos, bank runs, and panic. People lost trust in the banking system because there was no way to quickly get emergency funds during a crisis. Many reform ideas popped up. Some wanted to let banks operate across state lines, creating a more flexible banking system. Others suggested elastic currency systems that could expand or contract with economic needs. But powerful banking interests, who profited from the current system, fought hard against these changes. They wanted to keep control and protect their profits. The political battle heated up around the Aldrich Plan, named after Senator Nelson Aldrich. He led a secret group to study how other countries managed their central banks. The plan was to create a central bank controlled mainly by private bankers. Many populists and progressives saw this as giving too much power to the big banks and feared it would hurt ordinary people. To get broader support, compromises were made. The final Federal Reserve Act created regional Federal Reserve banks and included some government oversight. Still, it kept significant influence in the hands of banking elites. This was a win for the powerful but a loss for those wanting a more democratic system. From a libertarian point of view, the creation of the Federal Reserve shows how government and big banks work together to form a system that benefits the few at the expense of the many. Libertarians believe the Fed's monopoly on money creation distorts markets, fuels inflation, and concentrates economic power. They argue it was set up not to serve the public but to protect the interests of wealthy bankers and politicians. Libertarians often suggest that the economy can grow well without a central bank. Before the Fed, the United States expanded rapidly with a more free market approach to money. They support reforms like ending the Fed's monopoly, increasing transparency, and letting market forces determine the money supply. They believe these changes would reduce economic distortions, prevent inflation, and give individuals more control over their finances. In the end, the Federal Reserve was born from political fights between reformers, government officials, and banking interests. Its creation reflects a compromise that gave big banks and politicians more control over money. From a libertarian view, this process highlights the risks of government collusion with financial elites, which can limit personal freedom and distort the economy.